Gabriela, I know that it's a big day with CPI and bank earnings, but honestly, I couldn't stop looking at IBM. I thought it was such an interesting story because IBM comes out and says, look, our customers, they need to spend on chips. They need to spend on hardware. Their things are getting really expensive, so they kind of have less of a cushion to spend on software. We've been talking a lot about the huge chip spend, and I wonder for a lot of companies, if this is like the second wave of threat for a lot of tech companies and software companies that basically CapEx are being absorbed by just how expensive chips are right now.
Yeah, I think this is really an example of how software is the poster child this year for investors thinking and pricing in not just AI disruptors, but also those that are most at risk of being disrupted. Not because of fundamentals themselves. If we look at the software group as a whole, grew earnings close to 30% in the first quarter, set to still be strong. But of course, there are questions around the business model. And we think still a lot of CTOs are very focused on the AI story, AI adoption, rationalizing token usage. So maybe there's still some wrinkles for the group in the short term. But medium term, there's still a lot of very solid businesses within the software group, especially those that really have very vertical businesses, proprietary data, and that can add AI solutions on top of it.
I mean, this is why the banks did so well equity trading, right? Because IBM drops literally a fifth of its market cap in one day, and then it sort of clambers back up, and you have the memory stock selling off and so on. Yeah. What about inflation? Are we out of the woods?
There's so much excitement within the market. I do think still tech and these AI questions are driving a lot of that action beneath the surface, but undoubtedly the macro news that we got this morning is a relief for investors, especially listening to Governor Governor Waller yesterday in his speech. One of the more hawkish voting members talking a lot about how he was worried about the reacceleration in core inflation. This month's print is a huge relief. Now, as he said yesterday, 1 month doesn't make a trend, but at least having seen softer prices across the core components, at least takes a hike in July off the table and can keep the Fed on hold, we think, for the remainder of the year. That's a big risk that we're seeing decrease for markets.
Waller was like poetry yesterday, can I just say? Sternly staring at inflation until it melts before our withering gaze is not an option. But it almost feels like if you were to stare at this month's report and pray for a similar one, that it is withering away. And the pass-through from higher energy costs, it's not there. Do you expect that to repeat? Or considering that war has reignited in the Middle East, or at least escalation has, that there will be elements of pass-through of higher energy costs?
I was in the room there at that lunch with Governor Waller, and he got a lot of laughs, including for that one poetic line. I do think one of the things that he and other more hawkish Fed members have been pointing to is, look, we're not just worried about the headline. Of course, sustaining around $4 a gallon for gasoline is an important, necessary, but not exclusive condition for the Fed to get more comfortable around inflation. And he was really honing in to core inflation, and that's why this flat reading this morning is a big relief, and if sustained, could really take the pressure off from these more hawkish members. And it was undoubtedly good. I think it's just also worth mentioning. It wasn't just a couple of special items. There were some that declined, like auto insurance, but if you look at other important components of core services and core goods, they were soft, especially shelter really only rising if you look at rent 0.1 or owner's equivalent rent 0.2. That is a more normal pace of price increases.
It does feel, though, that this market and any investor in it is a little bit not quite on solid ground. I mean, you had a 10 basis point move in one direction with the 2-year, and then it reversed that move precisely because we didn't know what we were going to get, Gabriela. So what do you tell investors? I mean, how invested should they be in growth, in the riskier stuff? How invested should they be in, less risky items?
I do think still this macro question, and specifically the inflation and rates question, is still key if you look at the fixed income market and if you look at currencies. And so really, I think the short end of the curve is where you've seen the biggest adjustment post Iran war kickoff. Still short end, that's price for inflation, price for a Fed rate hike. The 2-year has moved up 80 basis points this year. And actually, we think creates a lot of value on the short end because we don't think we'll see sustained inflation pressure in the core, and then ultimately the Fed won't have to hike. So opportunity there. For stocks, though, that's where really the intra stock churn is the most important question, and that is all about AI, and specifically AI CapEx. And that's where the upcoming few weeks of tech-related earnings are going to be so important. The market is so jittery, especially looking at your high-flying semiconductor, especially memory names, to any kind of whisper of a deceleration in the pace of CapEx.
Well, the Bank of America team is pointing out that investment in asset managers are very, very bullish right now. Their cash levels dropped to 3.6%. It was above 4%, saying that it rings the contrarian alarm bells. What are you seeing among your clients? Is there exuberance in equities right now?
What we're seeing is a lot of enthusiasm for investing in across the capital markets, and really the giant sucking sound of AI. And so a lot of enthusiasm in following the money from the hyperscalers, the CapEx spenders, to the whole AI ecosystem supply chain that's benefiting from those CapEx dollars. I mean, the kind of earnings growth we're seeing is extraordinary. 100% earnings growth for the semiconductor group. We're seeing close to 40% for hardware, for power. It's just astounding. And really, we're seeing a lot of excitement investing in across public equities as well as private capital as well to fund this whole AI CapEx surge. Now, where we are seeing some more concern for investors is just how far things have run. And we have been talking to a lot of investors about thinking about, are we thinking about sizing and actual stock selection carefully? Because these AI tantrums that we started to see in June seem to be a feature now, not a bug.
And you have to imagine the Fed is thinking about that as well, right? Because there's a part of this economy that is very dependent on that wealth that's being created by the stock market. Just on that, are you at all concerned about the labor market? Because you don't see any rate hikes for the end of the year, but it does feel like if we got one more soft jobs report, maybe we'd suddenly be starting to think about a cut again.
I think this was what was interesting about the speech from Governor Waller yesterday, who was one of the most dovish members last year, very worried about the labor market. It was basically no job creation for the vast majority of 2025. And then things have really improved since then. I wouldn't say it's a hot labor market, but it's normalized to a good, healthy pace of about 111,000 jobs created over the last 3 months. So I do think for those that might have been worried about something breaking in the labor market, the past few months of data have really calmed these fears. It's an okay economy. And I think if you think outside of AI, that's where you don't see a lot of interest. It's not an economy falling off the cliff, but it's also not that exciting. So where is just good enough economic growth good? I think banks fall in that camp.
Yeah.
But we would not be chasing what was an initial rotation into your more cyclical consumer names.
Just very quickly, Gabby, because we're basically out of time. Did you take comfort in the bank numbers this morning?
I think you're seeing really good numbers, not just from capital markets, which there was already a lot of expectation about, but also about loan growth picking up, including C&I loans, good regulatory environment, and very low defaults, delinquencies, and net provision. So I do think the macro read-through is very good, and including for banks, which we like.